So now it's a triple whammy of worries. Add China to the US and Europe. Today's news is that the HSBC Bank's monthly manufacturing index has dropped to a 32-month low of 48, down from 51. That means Chinese manufacturing has unexpectedly gone from expanding to contracting. Now, it doesn't mean China is in for a hard landing, and it's far from a rerun of 2008-9, but after 5 months of readings at around 50, confidence in the economic prospects of our largest customer took a hit today. What it probably means is that China is about to join the rest of the world in worrying more about growth than inflation. So we could see some monetary and fiscal stimulus in China before long, which will be good news for those behind the other piece of economic news today, construction and engineering in Australia. Just look at this. Engineering work grew by 22% across Australia in the latest quarter, and in Western Australia the growth was 64%. Now, virtually all of this is to supply China, so let's hope they still need the stuff. There was a near 2% decline on the local share market as a result of the Chinese dim sum, with heavy falls recorded by the mining giants BHP and Rio Tinto, as well as the banks, with NAB the worst affected. One Steel also continued to be sold off because of BlueScope's low-priced share issue. BlueScope itself remained in a trading halt. It won't be pretty when it comes back on. And share markets around Asia fell heavily, led by those closest to China, Hong Kong and Taiwan. And that was after a 0.5% fall in New York and something similar in Europe on average. Finally, the Australian dollar is really tumbling now as investors look to close out their risk asset positions, down more than a cent today to less than 98 US cents. And that's finance.